Hello, everybody. I'm Bennett Tchaikovsky, and welcome to Intermediate Accounting, Current Liabilities. And this is going to be part one, where we're going to be exploring commitments and contingencies. My disclaimer and copyright notice: the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. Presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will be making reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright of those third parties. So we're going to be looking today at contingent commitments and contingencies. And so the one thing, I actually was in a meeting once and they looked at us and they said, well, how many of you have been sued? And a lot of people raised their hand and they said, well, everybody's going to get sued at least once in your professional career. And that's the importance of having directors and officers insurance and essentially being protected in the event that you will be sued. If you ever do serve as a board member or an officer of a corporation, you want to have directors and officers insurance. Why is that? They are going to sue the corporation, named officers, and board members. So, but from a commitments and contingencies perspective, like lawsuits are going to be a part of life. And as accountants, we have to disclose appropriately all potential lawsuits as a result of different company actions. Now, from a practical perspective, what actually happens? Well, the auditors are going to come out to the company and they're going to essentially say, okay, we want to talk with all of your outside counsel and we want to obtain from them, which is going to cost you money, a certain letter that is going to be going through. And they sometimes use it called an SFA-S5 letter. I'm probably misspeaking it, but in any event, I pulled this from Investopedia and I'll put the link below. It's a great thing. It's really does this really up well. So part of the auditor's process is you have to confirm with outside counsel as to any sorts of lawsuits that are going on. And the key here is it's always about disclosure. And what I will also tell you too is when it comes to the SEC, when it comes to dealing with anybody, you have to make sure it's better to disclose than not to disclose. So over here is that the purpose of the attorney's letter is to inform and certify to the auditor of any legal action against the client that could result in adverse financial impact on the company's financial statements. Attorney's member letter makes a significant part of the financial audit process. It absolutely does. And you have to go through and confirm with counsel. So again, it's not even requesting a letter for any audit, and particularly if they have a doubt, you have to go through and request those letters anyways. And essentially, you're wanting to make sure as an auditor is when management is making the assertions that, these are management's financial statements, that those assertions are in fact correct. And when you kind of go through and look at this over here, the information we gather is basically, is there any situation that could be of a potential loss through litigation, the exact time period when the matter caused the litigation occur, the likelihood that an outcome will be negative to the company, and an estimate of the potential loss. It's very important. So again, the attorneys are basically verifying management's assertions. Now, in terms of how do we go through and record, there's essentially really four different situations. If it is remote, meaning that the likelihood of any outcome, this is basically going to be no disclosure required. If it is reasonably possible, right, meaning that it could happen, we're going to disclose in the footnotes. Now, here's where the big one comes in. If it is probable, but we cannot estimate it, we still have to disclose it in the footnotes. But if it is probable and we can estimate, we're going to do two things. We're going to record it in the financial statements, and we're also going to disclose it in the footnotes. Also, too, over here, obviously, we have insurance oftentimes to basically help us with those, mitigate those losses. And then there's also going to be risk factor disclosures and financial statements, what I'm going to show you momentarily. Now, for this, I always like to go to our friends at Johnson & Johnson. right? It's always fun to look at these guys over here, and it's because let's take a look at this one. So this is our most recent 10K that was filed on February 11th for the year ended December 31st, December 28th, 2025. And we're going to start over here like, okay, this is on page like 94, like so the top of page 95. So Johnson& Johnson and certain of its subsidiaries are involved in various lawsuits regarding product liability, intellectual property, indemnification, and other matters, governmental investigations, and other legal proceedings that arise from time to time in the ordinary course of business. And if we look at this, matters involving talcum powder or talc, coming over here, matters involving opioids, matters involving product liability, right? Ethicon, flexible mesh, all this kind of stuff. And we're now on page 98. Remember, we started the page, top of page 95. And we keep going, and we keep going, and we keep going. And will it ever end? General litigation. And we're now at page 20. So we've gone from page 95 to page, basically half of page 104 of various different lawsuits. And so again, all these Johnson & Johnson probably has an army, maybe a seven-nation army of different attorneys that are out there that are going through and doing this. So the auditors are going to be sending out letters to basically confirm and to basically verify what's being disclosed. Now, in a company the size of Johnson & Johnson, you are probably going to have a chief legal officer. That chief legal officer is going to have counsel that is going to be in-house more than likely and will be going through and basically working with the outside counsel. Now, the key is that when you get to be a large enough size as a company, you want to have in-house counsel really to manage the out-of-house counsel, outside counsel. And it's just because with attorneys billing and everything else, it can rack up there. So accountants will be sending out or the auditors will be sending out these letters to the attorneys that work for the company. And then they'll be going through and essentially confirming the various different things that are happening. Now, the other thing too is risk factors. And what you kind of see with companies, and this is on the company's 10K, which is essentially the annual report. So when you look at the annual report, you see, okay, this is all about our business. And now we get over here to risk factors. So risk factors start on page 9 and they go down. And this is really when we describe risk factors. This is the investor is when they are purchasing securities in Johnson & Johnson, it really comes down to like, okay, are they aware of the risks that are involved with their business? And so coming down over here, when we come down over here to page 9 and we're looking at, basically at risk factors, an investment in the company's common stock or debt securities involve risks and uncertainties. The company seeks to identify, manage, and mitigate risk to our business, but uncertainties and risks are difficult to predict and many are outside the company's control and cannot therefore be eliminated. In addition to the other information in this report and the company's other filings with the SEC, the investor should carefully factor the risk factors set forth below. Investors should be aware it's not possible to predict all such factors. So again, when you look at this, this is going to be written specifically to the company's particular industry. Interruptions and delays in manufacturing operations, businesses in very highly competitive markets. We rely on third parties to manufacture and supply our goods. Counterfeit versions of our products can harm our patients. Global health crises, pandemics, other outbreaks can adversely disrupt our business. Governmental regulation and legal proceedings. And then you just got on more and more. And I'll copy links to this so you can check it out in their 10K below. Let me just do that real quick. So this is kind of like what we're kind of going through and seeing is that you see these different risk factors. So as a company, you're going to be going through. Remember, when a company does a 10K or 10Q, these are being reviewed by outside counsel just to really kind of make sure that you've got, the belts, the suspenders everywhere. But again, you've got risk factors, cybersecurity sections, properties, legal proceedings, and they're going to be, obviously they're going to refer to the footnotes of the financial statements, which is where we saw these. This was in footnote 19 of the 2020-25 annual report. And then you see other different parts of the 10K. So that's kind of like a general overview of commitments or contingencies. And again, this is the key over here is like, what are the probabilities? And just to kind of emphasize this real quick, UWorld has given me permission to go through and to look at, different, basically to kind of do a brief preview. And I'm just going to be kind of showing you over here, which is like just going to give you an example of how this kind of works. So right over here, the company has been sued for $2 million as a result of an injury, and legal counsel has advised that the probability is remote, right? That's the key thing. So over here, this is going to basically be no accrual because it's remote. The amount of accrual is going to be zero. Note disclosure, basically there's nothing required to be in the footnotes. And I'll just go ahead and look at this one right here. The company has been sued for $1.5 million as a result of an intellectual property infringement case. The attorney has advised that it is reasonably possible that it will lose the case and will incur a loss between $200,000 and $500,000. Now remember, if it is reasonably possible, we're just going to disclose. So over here, no accrual. No over here, the amount of the accrual. Okay, so I guess it doesn't like what I'm doing right now. Okay. So in any event, this will be no accrual, and then the disclosure required for year one. This would be the answer to me. That would be yes. Over here, the company has been fined $900,000 by the government because of certain clean air violations. The company has appealed, and legal counsel has estimated it is probable, and the fine will be reduced in amount between $200,000 and $500,000, but no specific range amount can be judged as the best estimate. So let's go ahead and just submit it. And let's see how we did over here. Okay, so let's take a look at this. Okay, so we got this correct. So there's no accrual. And then over here, the answer to this would be yes, because it is probable. And the answer over here would be the amount of the accrual would be, let's see. So row 3, row 4. Okay, so I would say that this should be $500,000. But again, that's my own opinion. I would basically err on the higher side of the amount. Let me just pause just for a moment. So here's something where I'm wrong, right? So right over here in this scenario, this 900,000, the company has been fined 900 grand by the government because of clean air violations. And so it's probable they're going to lose. And then basically they're saying a loss will be accrued to the minimum of the range. So here I would have done the full 500 grand, but they're basically choosing to do 200,000. I have a feeling the auditors would want 500,000, but that's okay. I'd be wrong on this one. But again, as you can see for these types of questions that are appearing on the CPA exam, and this is really the one benefit of using CPA review is that you'll have all the solutions for them, and they'll also give you, like, if you get an answer incorrect, it'll show you down over here, like, okay, where are the references to this? And then I can go here and I can either read up on it or I can basically watch a video on it. And you'll see over here that we'll have
developer for eWorld, and today we're in FAR discussing contingencies and commitments. This chapter has 3 AICPA representative tasks, one each.
And I don't know if you guys can see that on your end. Hopefully you can actually hear it, but that's usually how this goes. How this goes through and works. So that wraps up contingencies and commitments. Again, this is something that the management has to go through and disclose. If we're Johnson & Johnson, it's going to be a lot of pages and a lot of fun writing. But when it comes though to when it happens, like, in a more practical perspective, it's really going to be the interfacing with all those outside counsel who will be confirming to the auditors management's assertions as to those liabilities. So in any event, thank you so much for being here today. I look forward to seeing you on the next video. I appreciate you liking and subscribing to the content. If you feel free to leave me a comment or send me an email to ibc30tocpa@gmail.com. And I look forward to seeing you on future videos. Have a great day.